Okay, so we're going to set up an option pool. The very first thing we actually have to do, and I need to go back to do this, is we really need to have a bunch of common, because common is really what the option pool is about, although you could do it with preferred, but I'm going to put just a bunch of common in here. There's common, 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 common. And I'll leave the A preferred in there. And we've got some capital that's being raised, and we've got a pre-money value along the blue line here. It's a little bit obtuse here, so let's lower it a little bit. All right, we'll make about 300, and that's good. Okay, so now let's go all the way down to the option pool. So the first thing we notice here is we have our option pool, and I'm going to enter some options by spinning in a number. Let's go for 100,000 for the founders. And let's go a little bit more than that, 150, maybe 200. Keep on just going. Just throw some things in here so you can see what's going on. Yep, that's good. Make them even million up here. Okay, fine. So now we've issued or granted options in each of these periods. Of course, if you're not doing any raising of capital in these periods in here, you're not going to put any options in. They won't work. You always have to have them associated with another round of capital raising. All right, now this is very tricky, but I want you to try to understand what's going on here. Vesting is the period in which someone must hold the options before they can exercise them. Just because you give somebody an option doesn't mean they can immediately turn around and sell it or exercise it. So you have to hold it. Now here we have a spin button, and it goes up to 7 years. And if we had a 1-year vesting period, the option would be granted at the beginning of the year, and it says option vests end of year 1. Watch what happens when we go to the next period. It says option vests end of year 2. That's because this is also a 1-year vesting period. So all of these would be vested at the end of the period in which they were granted. Watch what happens if we go to 2. Now they've all changed. Here it says it's going to be the end of year 2, so they get them at the beginning right here, and they're going to vest at the end of this second period. These guys here get it at the beginning of period 2, and at the end of period 3 they vest. So watch what happens when we go to 4. Same thing. It moves it over. So these guys get it at the beginning here, and here's period 4, and they would get it at the end. That's why it says end of 4, 5, 6. But wait a second, we've just run off the edge here. What's up with this? That's okay. Those options won't vest until they're past the number of years that we're showing. But if there was an exit, we would accelerate those options. Normally, options get accelerated in any kind of a buyout or a merger. They want to get them cleared out. Now, let's go here and talk about the option value discount rate. So what is the option value? Option value is calculated by this formula right here. The exit value of that year divided by the fully diluted shares, that's going to give you the value per share or per option times the number of options that a particular group has. And of course it's going to change because the exit value changes through time. Now what happens is that we have a value in the future. We want to discount it back to present. If we go down to this table right here, I think you can see what we're talking about. Here we have years, and we've shown a total of 13 years, even though our model goes 7 years. Now, the stair step of yellow, this is actually the value of the founder options in year 4. Now, these little brown boxes with the red is you have to have a negative number in order to work out your net NPV. So we threw in a nominal cost to acquire the option. Sometimes you'll see words that say for $10 and other due consideration. That means sweat equity, hard work, being good, being on time, blah, blah, blah. So we have to show something here. And you can change these if you want. I personally would just leave them at a very tiny value, but you must have a negative number in there. Okay? Positive numbers are going to cause trouble right there. All right. So now what's going on here is this is the value of the option estimated because of its exit value, the enterprise exit value. This is what the option is worth. Now this number here is the discount of this is $99,822, and if you discount it by 20% per annum compound, you're going to get a $40,000 number. Now watch what happens, of course, when we increase the discount. I'll just move this guy right here so you can watch it. We're going to move the discount up, and of course that makes the NPV smaller. Now what we're going to do with this number, this 29052, is we're going to expense it each year of the vesting period. So if this was, let's say, $40,000, and we had a 4-year vesting period, then 1/4 of this number here would be deducted as an expense from your income statement. And that is what we're doing. Now let's look at another couple of sections here. Here we have to enter an option vesting exercise price. And I want you to look at the exit value of one option. It would be nice to make the red lines up here less than the expected exit value of one option. I actually have this moving up a little bit here. You got a $3.80 option, and I want to have it exercise at 2. This gets the company a little bit of money, and I believe we are accounting for that money that comes in. All right, so the next line is really a summation. This is the percentage of cumulative voting shares that the options represent. So in this particular case, we've got 10. Now it is not cumulating. This is 7.6% of the total is options issued in this period, and so forth and so on. It turns out there are a lot of options in this deal, and I can show you that by scrolling down. All right, so I'm going to scroll down to section 9, and here's my red guy. All right, so here are the options. You can see that we have a lot of options. These are cumulative numbers here. So the options vastly outweigh the founder, and they vastly outweigh the friend shares and all the other shares we have in here. So this is an incorrect type of option, but we just threw some numbers in, and now you see that that is a significant number. And you could probably get the sense of that. Let me get the red guy back again, X. You could probably get the sense of that by looking at each period. You're adding 7%, 6%, 7, 9, 13. Here we add 15% to the total outstanding shares just in this one period. So that's really a lot of options. The option pool. You want to spin in some options. You want to set up a vesting period. 3, 4, 5 years is good. A lot of people try to go for as long as possible. That will reduce, of course, the cost on your income statement. It depends on the value of the option and in the year. Remember, it's not worth much at the beginning, so if you have a 3-year vesting period, the third year for the first guy isn't very much, but then the third year for this guy out here might be a lot. But generally, the shorter the option vesting period, the more you're going to hit the earnings because you've only got a couple of years to amortize it. So you want to set some vesting periods. 3, 4, 5 years is good. Maybe a 20 to 25% discount rate. Make sure that your option vesting exercise price is less than and substantially less than what you think the value of the option will be. And there it is. You're done.